Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the topic of group accounts. So this is our lesson number 3. So in this lesson I want us to look on the various forms of purchase consideration and basically how we deal with such purchase consideration specifically in computation of goodwill. Remember what we have said in our previous session is that once the parent company has acquired a majority of the shares in the subsidiary, the parent company must pay the previous owners of those particular shares. So now there are various ways in terms of how the previous owners of the shares acquired by the parent company can be paid. One, they can be paid in cash. Number two, they can also be paid through something called a share exchange. We're going to look on details what is that. We also have another form of consideration known as the deferred consideration, and also we have another form of consideration which is known as a contingent consideration. So therefore in this case, first of all, we can say that the purchase consideration the purchase consideration paid by parent company to the previous owners, owners of shares, previous owners of shares can take the following forms, following forms. So number one, we have a cash consideration. Number two, we have a share exchange consideration. Number three, we have deferred consideration. And number four, we have contingent consideration. So therefore what we are saying is that once the parent company has acquired shares of the subsidiary, because those particular shares automatically were owned by some shareholders who have accepted to sell their shares now to the parent, then we are saying the parent company must compensate them, must pay them for acquiring their shares, or basically for those particular previous owners accepting to sell majority of their shares now to the parent. Now that consideration, that payment which is to be made now to the previous owners of those shares, then you're saying can take any of this form. We have now the cash consideration, the share exchange consideration, deferred consideration, and the contingent consideration. I want us to start with the first form of consideration, that is the cash consideration. So the cash consideration basically is whereby the parent company, after acquiring shares or majority of the shares in the subsidiary, will compensate the previous owner of those particular shares by paying them some cash, and that particular cash which is to be paid to the previous owner of the shares is paid on the date of acquisition. Of acquisition. So therefore we can say that this is a consideration in cash, and paid on the date of acquisition. Date of acquisition, remember we abbreviate that as DOA, date of acquisition. So in case the parent company pay the previous owner of the shares in form of cash, and that cash is paid on the date of acquisition, then when it comes to the computation of goodwill, this particular cash consideration do not have any special treatment. Basically what that means is that that cash consideration is used the way it is given in the computation of of goodwill. So therefore we can say that this consideration do not have any special treatment. This consideration do not have any special treatment. And it's also important to know how the parent company account for this particular cash what consideration. So once the parent company has paid some cash to the previous owner of the shares in the subsidiary company, so this is how the parent company will account for that. So like maybe we assume that we are told A Limited acquired 80% of the shares issued by B Limited and paid the previous owner of these particular shares acquired a cash of 100 million. A cash of 100 million. So how does this company, that is the parent company, account for this cash consideration? So the parent company debit an account called investment in B Limited with an amount of 100 million, of which this investment in B Limited, this one is recognized as an asset in the statement of financial position of the parent company. So once you go to the statement of financial position of the parent company, specifically under the non-current asset, you'll be able to see something called investment in B Limited, which is now the cash consideration paid by the parent company in acquiring 80% of the shares of what? Of B. And then the parent company will credit the bank account, the bank or even the cash account with the same amount of money. So in such a case, when computing the goodwill, the purchase consideration which was paid by the parent company will be 100 million. Will be 100 what? A million. So that is the cash consideration. So then from there we have the other form of consideration, which is known as the share exchange consideration. Number 2, share exchange consideration. And this is very, very common in the exams. So share exchange consideration is whereby the parent company will acquire majority of the shares in the subsidiary, and the parent company agree to compensate the previous owner of those particular shares by issuing its own shares. By issuing its own what? Shares. So mean that if, for example, A Limited here acquires 80% of the shares issued by B, so then those shareholders of B Limited who have accepted to sell their shares to A will not be paid in cash, but rather what the parent company will agree here to do is to issue its own shares to the previous owners of those particular shares in order to compensate them. In order to do what? To compensate them. So therefore you can say that this is where the parent entity, or basically the parent company, pays the purchase consideration, by issuing its own shares. By issuing its own what? Shares. The parent company pay the purchase consideration by issuing its own what? Shares. So here we have a form of a share exchange. So the parent company, for example, will acquire 80% of the shares issued by B Limited, and then those shareholders of B Limited who have accepted to sell their shares now to A, they will be compensated by A, they will be paid by A issuing its own what? Shares to the previous owners of the shares which have been acquired in what? In the subsidiary. Mostly, once the purchase consideration was paid by the parent company through a share exchange, the examiner will tell you two things. Number one, the examiner will tell you that the parent company had not computed the purchase consideration, and number two, the parent company had not accounted for that purchase what? Consideration. So therefore, anytime the purchase consideration has been paid through share exchange, you must be in a position to determine two things. Number one, you must be in a position to compute the purchase consideration paid through share exchange, and number two, you must be in a position to know how such purchase consideration is accounted for by the parent company. So therefore, how do we determine this share exchange consideration? Share exchange consideration. So this one is computed using this formula. So number one, we have to determine number of shares issued by parent company, number of shares issued by the parent company, and then what we do, we multiply those particular shares with their fair value. We multiply those particular shares with their fair value, and the fair value per share can also be known as the market price per share. So that's how we determine the share exchange consideration. Determine how many shares were issued by the parent company to pay the purchase consideration. Once you have determined those particular shares, multiply those particular shares with their fair value, or basically their market price, on the date of acquisition. The date of what? The date of acquisition. Then once you have determined that particular purchase consideration, in most of the cases, the parent company will not have accounted for the shares which were issued. So how should the parent company here account for these particular shares issued to pay the purchase consideration? So we can look on the accounting entries. Accounting entries for share exchange consideration. Number one here, the parent company, assuming it is A Limited. A Limited is a parent, and then B is a subsidiary. So when the parent company is accounting for this share exchange consideration, the parent company will debit an account called investment in B Limited with the full amount of purchase consideration here. And then remember, the parent company here paid the purchase consideration by issuing its own shares. So therefore, what we do, we credit the parent company ordinary share capital, and the amount credited in this account is always based on the par value per share. Is always based on the par value per share. And then in most of the cases, these particular shares will be issued, or basically you have said that when computing the purchase consideration, you have to take into account the shares issued, multiply those particular shares with their fair value or market price. So in most of the cases, the fair value or the market price per share will be more than the par value. So therefore, the amount which is above the par value, that is a share premium. So that one is credited in the share premium account. For example, if at the date of acquisition, if the shares of the parent company were trading in the securities exchange market at a price of what? Of 30, this is now the fair value or the market price per share. But you may be told that the par value per share is something like 10 shillings. Is something like 10 shillings. So the amount which is above 10 shillings, which in our case will be 20, is a share premium. So therefore, what you do, you take the shares issued by the parent company times the share premium, which is 20 shillings per share. That amount you do what? You credit it in this account, which is called what? The share premium account. So therefore, this is a very, very important concept which you need to understand, that whenever the parent company has acquired majority of the shares in the subsidiary, the parent company can pay for the shares acquired through something called a share exchange consideration. If that is the case, then the examiner will tell you two things: that the parent company had not computed that purchase consideration, and this is how we compute it. And number two, the examiner equally will tell you that the parent company had not accounted for that purchase consideration. That's basically how we do what? We account for it. So the parent company should debit an account called investment in B, and actually this one now will be used in the computation of goodwill. And then the parent company credit its ordinary share capital with an amount which will be based on the par value, and then still credit an account called the share the share premium. So I want us to look on a small illustration which is here, and the illustration reads: the parent company has acquired 12,000 shillings 1 share in a subsidiary by issuing 5 of its own shares, by issuing 5 of its own shillings 1 share for every 4 shares in the subsidiary. The market value of the parent company shares is shilling 6. So what are we required to do? We are required to compute the share exchange consideration and show how the parent entity will account for it. How the parent entity will account for for it. So let's look on that illustration here. And we are told that the parent entity acquired 12,000 shares in the subsidiary. So the parent company, this one we are told it acquired 12,000 shares in a subsidiary company. And in this case, we are told the parent company paid for these shares which were acquired by issuing 5 of its own shares for every 4 shares acquired in the subsidiary. For every 4 shares acquired in the subsidiary. And then you're told the shares of the parent company had a market price of what? Of shilling 6. So what are we required to do here is to determine the share exchange consideration, and basically show how that will be accounted for by the parent company. So for us to be able to determine this, the first thing we have to recall is the formula. How do we compute the share exchange consideration? This is a formula which you have to remember always, this one. This is a formula which you have to remember for computing now the share exchange what? Consideration. So in this case, we have said number 1, we have to determine number of shares issued by parent company. The parent company issued how many shares, and then multiply those particular shares with their fair value or with their market price on the date of acquisition. Like from the information which are given here, we are told that the parent company acquired 12,000 shares by issuing 5 of its own shares. So that will help us in terms of computing this. So the parent company was to issue 5 shares for every 4 shares in the subsidiary, or in other terms, for every 4 shares acquired in the subsidiary. So in our case, we know that the shares the parent company acquired in the subsidiary were 12,000. So these are the shares now which were acquired. So what do we need to do? We need to determine the shares issued by the parent company. So we cross multiply here and we divide. So we have 5 times 12,000 divided, we divide that with what? With 4. So this will give us 3, so which will give us 15,000 shares. So these are the shares which were issued by the parent what? Company. So having that, we just need to multiply those shares with their fair value or market price on the date of acquisition. 15,000 shares. And then going back to the information which are given in our illustration, we are told that the shares of the parent company on the date of acquisition, they had a market price of 6. So we multiply the 2. So which will give us 90,000. Yes. So this is the purchase what? Consideration. So when computing now the goodwill on acquisition, the purchase consideration will be how much? Will be 90,000. But equally, what we are required to do is to show how the parent company will account for this 90,000. So we can go further and show the accounting entries. Accounting entries. So the parent company, with this particular amount which you have computed here, 90,000, will debit an account called investment in the subsidiary company. So which in our case would be how much? Investment in subsidiary company, an amount of 90,000, and then credit the ordinary share capital. The parent company will credit its ordinary share capital. And remember, you have said that the amount credited in this account is always based on the par value. So what is the par value per share? The par value per share is also known as the nominal value, is also known as the face value per share. And basically, this is a value of the share which is stated in the capital clause of the memorandum of association. Is the value of the share stated in the capital clause of the MOA. But on the other hand, when we talk about the fair value or the market price, this is the value of a share in the securities exchange market. So the share, the shares of the company in the securities exchange market, they are trading at a price of what? So that price, we refer to it as the fair value or the market price per share. We are saying the amount to be credited in this account always has to be based on the par value per share. And in our case, we are given that because we are told that the parent company acquired 12,000 shares of shillings 1 in the subsidiary by issuing its own shillings 1. Its own shillings 1. So basically what that means is that the shares of this parent company, they have a par value of shillings 1. So therefore, we take the shares issued by the parent company, 15,000, times the par value per share, which is 1. So that will give us 15,000. That is the amount we credit in the ordinary share capital. And then, because the shares were issued at a price of 6, the amount which is above 1 shillings, which is now a share premium, that will be credited in the parent company share premium. So the amount to be credited here will be equal to the shares issued, 15,000, times the share premium. The share premium in this case will be 6 minus now the par value, because the share premium is an amount which is above the par value. So the share premium per share is 5. So which will give us 75 what? 75,000. So that's how we determine the purchase consideration paid through share exchange, and also how we do what? How we account for that. How we account for what? For that. So that is the second type of purchase consideration. That is the share exchange what? Consideration. Then from there we have the other type of consideration, which is number 3. You've already looked on the first one, the cash consideration, the share exchange consideration, and then number 3, we have a deferred consideration. Deferred consideration. So what is a deferred consideration? As the name suggests, deferred consideration is a consideration to be paid by the parent company on a future date. On a future date. For example, the parent company can acquire the subsidiary company today and actually promises the previous owner of the shares which have been acquired in the subsidiary to pay some cash in the future. And because that cash to be paid in the future still forms part of the the purchase consideration, and which must be used in the computation of goodwill, and the goodwill has to be computed on the date of on the date of acquisition, that consideration to be paid in future has to be discounted to its present value. Has to be discounted to its present what? Value. So therefore, first of all, we can say that this is a consideration to be paid, or we can just say this is a cash consideration, to be paid in the future, to be paid in the future, to be paid in the future. And then in this case, we have said that it must be discounted. It must be discounted to its present value using the parent company, company cost of capital, using the parent company cost of capital. So I mean that for discounting purpose, the parent company cost of capital here would be the R, So deferred consideration, a cash consideration to be paid in the future. And then we are saying for the purpose of computing the goodwill, what we have to do is to discount it to its present value using the parent company cost of what? Parent company cost of capital. Yes, so I want us to look on an illustration regarding the deferred consideration, how we deal with the deferred consideration. So the illustration reads, the parent acquired 75% of the subsidiary 80 million shillings 1 share on 1st January 2024. It has paid shillings 3.5 per share and agreed to pay a further shillings 108 million on 1st of January 2025. The parent company cost of capital is 8%. So what are we required to do? We are required to compute the total cost of combination and show how it will be accounted for by the parent entity. So we are given an illustration there, and what you're required to do is we compute the total cost of combination. So when talk about the total cost of combination, we are required to compute the total purchase consideration, because in this particular illustration here we have a consideration which was paid in cash. The other one is to be paid in what? In the future. But basically what we are told is that the parent entity or the parent company, first of all, acquired 75% of the shares of a subsidiary. And actually we are told that the shares issued by this company were 80 million. So mean that this company acquired 75% of that on 1st of January 2024. 1st of January 2024, that is the date of acquisition. And we are told it paid shillings 3.5 per share in cash. So basically what that means is that we have some consideration which was paid in cash, and I think we can just determine that, which is the cash consideration. So the cash consideration would be equal to the amount which was paid per share, 3.5, times the shares now which were acquired. So the shares which were acquired by the parent in the subsidiary will be equal to 75% of 80 million. 75% of 80 million. So this will give us now the consideration which was paid in what? In cash. So let's compute this. We see what it will give us. So we have 0.75 times 80 times 3.5. So this will give us 210 million. So this is now the cash consideration. And then we also told that the parent company promised to pay a further cash of 108 million on 1st of January 2025. So this is now what we have referred to as the deferred what? Consideration. Deferred consideration is basically a cash or additional cash to be paid by the parent company, but in the future. So basically what we have said is that because this consideration of 108 will be paid in future, so for the purpose of computing goodwill, you can't use it as 108. So what you have to do, you have to discount it. You have to get its present value using the parent company cost of what? Capital. And basically, we are told the acquisition took place on this date, 1st January 2024. That is the date of acquisition. And then you're told that this 108 million will be paid on which date? It will be paid on 1st of January 2025. Basically, that will be paid after 1 year. So what we need to do, we need to discount it. We need to get its present value. So how do we get the present value of this 108 million? So we multiply this with the present value interest factor at the rate of 8%, because we use the parent company cost of capital, and for 1 year. So therefore we take 108 million. So how do we compute this? We take 1 plus R, which is 8%, or basically 1.08, which will be 1.08 raised to power negative 1. Our N will be 1. So this now will give us the present value of that deferred consideration. So we have 1.08 raised to power negative 1 times 108 million. Yes, which will give us 100 what? 100 million, which will give us 100 million. Maybe you can take that off again. Yes, that will give us 100 million. So therefore, the total purchase consideration, which will be used in the computation of goodwill, will be equal to the cash consideration. Remember, there was a consideration which was paid in cash, which we have here. Actually, we can split it here. We have the cash consideration, which is 210 million. And then we also have the deferred consideration. Deferred consideration, which is 100 million. So we get the total, which will be 310 million. So this is now the amount of consideration which will be used by the parent company in determining the goodwill arising from business combination. So therefore, that's how we deal with what IFRS as a deferred consideration. Then we have the last consideration here, which is known as the contingent consideration. Contingent consideration. Contingent consideration. So number 4. So what is a contingent consideration? This is a consideration which is to be paid by the parent company in future upon a fulfillment of certain conditions. So mean that the parent company, for example, can promise to pay the previous owners of the shares which have been acquired in the subsidiary company once certain conditions have been met. For example, the parent company can promise the previous owners of the shares acquired in the subsidiary that if the subsidiary company profit exceed 100 million or even 200 million, then the parent company will pay an additional consideration. So therefore, you can see that this particular consideration here will only be paid upon certain conditions being met. Upon certain conditions being being met. So we can say that this is a consideration. This is a consideration to be paid by parent company in future upon fulfillment of certain conditions. Certain conditions. And equally, because this particular consideration will be paid in the future, it is actually treated in the same way, just like the deferred consideration. So in most of the cases, the examiner will give you some information regarding whether these particular conditions are likely to be fulfilled. If the conditions are likely to be fulfilled, then that consideration automatically have to be paid, and therefore, for the purpose of computing the goodwill, it has to be discounted to its present value. So therefore, you can say that this consideration is also discounted to its present value using parent company cost of capital. Using parent company cost of capital. Using parent company cost of capital. Yes. So that's basically how we deal with what IFRS as a contingent consideration. Therefore, we can say contingent consideration and deferred consideration are almost the same, but the main difference is that this contingent consideration will only be paid by the parent company on fulfillment of certain condition. But when it comes to deferred consideration, there are no conditions which need to be fulfilled there for the parent company to be able to pay that particular consideration. So therefore, these are the various forms of purchase consideration, and basically the ones which are very, very common in the exam is the share exchange consideration, the deferred consideration, and therefore you must be in a position to know how to deal with those various forms of purchase consideration. So I want us to stop at that particular point. So once we come back in our next session, we're going to look on how we prepare the group account, specifically whereby the parent company has invested in a subsidiary. So see you in the next session.